Wall Street. Big banks expressing optimism about the resurgence in capital markets when reporting fourth quarter earnings this week, but warning risks to the recovery. Bank of America reporting lower fourth quarter profits after being hit with regulatory charges tied to the failures of Silicon Valley Bank and Signature Bank. Let's get into it now with the Chairman and CEO of Bank of America, Brian Moynihan. Brian, great to see you.
It's great to be here, Maria. It's a little cloudy here today, but it's been a nice week so far.
It has, and this shot is just crazy gorgeous, right? Give us your take on those regulatory charges, on what impacted earnings and where you see growth.
So for the fourth quarter, we earned $3.1 billion after tax. We had two charges. One was the FDIC charge for the banking industry to put the money in the fund for the bank failures last year. That was $2.1 billion. And then we had a technical accounting change, which the money goes through the P&L, and then we get it back in the next quarter. It has to do with BISB being terminated. But on an operational basis, we earned $6 billion after tax and 50% return on equity. Since the pandemic started, when everybody thought banks were going to struggle to earn money, we've earned $100 billion after tax. This year we earned 26.5, 29 adjusted for that. The company's doing well.
That is incredible, $100 billion in that just short period of time. What leads growth in the coming year? I mean, we're all talking about the Fed changing and pivoting. That should be good for you.
Yeah, well, the squeeze on margins, because what happened is, as rates went up, the deposits lagged that. You make it. That comes back into sync. But what we've told people is we're kind of in the trough area now, this quarter, next quarter, and then we start to grow NII, net interest income, which is loans versus deposits, the spread. We grow that in the second half of next year, and we feel very good about that. So even with a bunch of rate cuts, which actually hurt you in some respects because the floating rate stuff drops, we still can grow the NII, which is good.
And that's really the rub, what everybody's talking about, the amount of money that you can charge on deposits versus the amount of money that you can take in on loans. There's rarely any movement on any rates on deposit accounts. Should we expect any change? You're going to raise any deposit rates anytime soon?
Oh, yeah, we've raised it. We're, I think, 160 basis points all in. But that's a bunch of checking accounts that are zero combined with a bunch of, if you have a CD, it's a 4.5%, 5%. So it really is what's the money used for. And we think about it. You have transactional cash, which is going in and out of the account, and you have savings cash, and we pay rates for that, or it wouldn't stay with us. And we have 1.9 trillion plus of deposits, and they grew last quarter. And so we have almost as much deposits as we did at the beginning of 23, at the end of 23, which is interesting because the whole world thought the deposits were going to come out of the system because of Fed changes and quantitative tightening. You pick your story. And the answer is we grew basically flat in deposits.
Well, in fact, the deposits went to where people trusted, like Bank of America. So there was a shift in deposits. What can you tell us about the banking system overall? Because the tight credit environment has been an issue. Obviously, earlier in the year, last year, with the failure of Silicon Valley Bank, people were worried about the health of the system. What do you want to say?
The banking system has great capital, great liquidity. It's well regulated. We were a source of strength in that. Those are particular business models that had particular issues and particular circumstances, but you didn't see it. Everybody thought it would run across the industry, and it didn't. And that's because they were unique things. The rest of the industry weathered the storm and then got back on its feet, and you're seeing it grow again. And that goes to show you that 15 years plus after the financial crisis, we've kind of figured out the right balance between capital, liquidity, what you can do in a bank, what you can't do in a bank, and getting it all straight. That's a part of the reason why we're saying let's stop on these new capital rules and stuff. We've got it figured out pretty well, and let's let this keep working through the system.
Yeah, I'm going to get to the capital proposals from Basel in a moment, but assess the consumer for us, the mortgage business, in the face of 11 rate hikes. How's the consumer doing right now?
So if you had to separate the consumer on the spending side, last year when we were here, we were talking about 10% growth rate in money going out of our accounts in the economy from our consumers. That's down to about a 4 to 5% growth rate. That is more consistent with a 2% inflation, 2% growth economy. That's what it was in 16, 17, 18. 10% was very strong, and that's what was causing inflation to purchase power. So the consumer is spending at a good level. That's come down during the course of the year, mid-23 on. They're in good shape. The credit quality in consumer, even though it's normalizing, people forget that it's normalizing to 2019, which is one of the best years in the history of the industry in terms of credit. So, yes, it's normalizing, but only getting back to normal. Inflation hurts consumers. There's no question about that because the prices and the wages. But there was wage growth, and then there was inflation, and people are still sorting through that. And that's where you got to get inflation down because it affects the people median income and down who have got to use most of the purchase into inflation-driven prices as opposed to other people not. So that's the tough part. But the credit's good. They have access to credit. and they got money in their accounts. And even the lower balance accounts at our company are still multiples of the pandemic. The higher balance moved it into the market to get that interest rate you're talking about. But the people whose transactional accounts are sitting with money, they're spending it down, but it's still there. And that'll come out of the system over time here. But the consumers are in pretty good shape.
I'm just wondering if the full effect has been seen of 11 rate hikes from the Federal Reserve.
It hasn't. That's why they've got to be careful that they don't overshoot, because the drag on a middle market company whose line of credit went up by 500 basis points, to make it simple, that's still affecting their decisioning. And so you're seeing them use a little lesser lines. Why? A, they cost more. It makes them more conservative. The mortgage market you talked about, mortgage demand is very low because rates went up and everybody froze for a while. They'll get used to it. You and I, when we first bought houses, 8% mortgage was considered just fine. It's just that for so many years, people aren't used to it. So that'll take a while to adjust. That slowed that down. So the effects of those things are still going through the system. And that's why the Fed can really sit here, let it work, and potentially needs to bring the rate structure back into alignment. It'll still be higher than zero rates. It'll be 3% front-end rate. Our team has predicted at the end of 25, 300 basis points, 3%. But that's not a high rate in the grand scheme of time. It's just a high rate since the financial crisis, where rates never got back to normal.
It sounds like you're not expecting 6 rate cuts from the Federal Reserve.
Our team has 4, and I think there was a swing after the inflation figures to 6 and 7 cuts. It's coming out of the market. That's what you're seeing a little today. One of the things that I've said is we've got to get the rate curve normalized and kind of get the debate, the daily debate about what's the Fed going to do tomorrow, out of the system. Because at the end of the day, what drives the U.S. economy is the consumers and the businesses.
Yeah.
And when there's this much change going on, that's when all the uncertainty comes in. Leave aside geopolitical certainty and other things. When the Fed's done, then the capital markets reopen. Then people say, okay, 3.5% to 4% unemployment rate. I got my job. I got my wages. Things settle in. But as long as it's moving, and that's where we got to normalize the American economy. Because at the end of the day, you got to unleash the entrepreneurs, unleash the consumers, unleash the businesses to drive it.
Which is what I worry about with regard to small business, because small business as well facing much different rates today than they were in the prior 15 years.
Now, our small business loan demand's been very strong. It's the balances are growing and the demand's been strong. But it's costly, and so if they can get the rate curve normalized in steepness as opposed to flat, the front end rate, because it's mostly floating rate borrowing, will come down, and that'll provide a benefit.
Let's talk about the Basel III proposals. Major banks urging the Federal Reserve to overhaul this draft rule. This is hiking bank capital expectations. We're now in the end game of the Basel III end game, and we're in the end of the comment period. What is your assessment of these proposals?
The basic point I'd make is it increases our risk-weighted assets, the way you calculate our capital ratios, by 20%. That takes about $300 to $500 billion of lending capacity out of Bank of America. We have enough capital to meet the rules when they come in because we have a lot of excess capital sitting there today. But why would I take $300 billion out of lending capacity, $500 billion? Because what does that affect? That affects the small and medium-sized business in the United States. We're the largest small business lender. So look, the simple example is if the capital rules in the United States are higher, 2 companies which compete in the global supply chain making bumpers for cars, one in Michigan, one in France. The French banks have lower capital, therefore they're going to have lower cost of borrowing, therefore they're going to be more competitive. So it's not the bank competitiveness, we talk about that, but it's really our ability to help the economy drive that's the competitive risk. And that's what we're saying, is a cost-benefit analysis been done to understand that dimension? And we said it, and there wasn't one done. And that's that's the kind of questions we're asking. And the question is, why now? And why not just stand back and take the 15, 17 years of work after the financial crisis and stress testing and HQLA and all these acronyms I can throw at you, and people say, well, what the heck is that? Why not just keep letting that work? Because at the end of the day, we went through a crisis in 20 with the pandemic. The banking system was stable and helped it. We went through a crisis, banks, 22, stable to help it.
Yeah.
Why add more now?
Yeah, bottom line is if you're paying more capital, if you've got to hold more capital, it's got to be passed on. You're going to pass it on. Somebody's going to pay the piper.
Our shareholders deserve to get paid. We're going to have to pass it on.
Right. Brian, it's great to talk with you this morning.
Good to see you.
Thanks so much.
Thank